Hello, everyone. Welcome. Today we've got an old friend on the show. Matt, take it away.
Thanks, Kylie. Welcome, everybody. Thank you for joining us today. Happy to welcome back Darris Cassidy, who I've known for quite a number of years, has worked with us extensively over the years, and the last year about this time left to go to work as the president of a family office. So he's had the opportunity to kind of be on the both capital raise side from family offices, along with a lot of other high net worth accredited investors, and then also now kind of being on the other side and being approached by lots of managers. So we're going to just kind of start anywhere, go everywhere today in a discussion. And so Darris, welcome back. Good to see you again.
Thank you. Yeah, thank you. Thanks for having me.
Of course. So maybe we'll start just with, and it's a crazy world out there. Lots of crazy stuff happening. So sort of, why don't you just give us your take on the overall real estate market and what you're seeing happening out there, and just from your perspective, kind of
Sure.
where do you think things are at and where are they going? And love to hear your crystal ball, because it's maybe clearer than
Yeah, I don't know that it's all that clear. I think that's been the one of the more bizarre parts of this particular cycle for me is that it's hard to know where certain things are going, and it feels that more than I've really seen throughout my career, that different asset types and asset classes are priced in all types of different ways. And so that's creating a lot of uncertainty as to whether things are a good buy right now, or, if, and the uncertainty as to what the future risk in certain particular assets are. It's hard to kind of understand certain supply or demand factors, macro economic situations, political situations that might influence how people use real estate and what the future demand for certain asset types or geographic locations is going to be. So yeah, it's a really interesting time. I was talking with someone the other day that I feel that, obviously interest rates shot up, and it took a while from my view, for cap rates to adjust accordingly and go up along with the rates, to therefore decrease the value of assets to bring them into where the pricing can make some sense. But what I have found really interesting is, now that that has occurred, what I've seen throughout my career is that a lot of times when values drop, they'll drop below replacement cost, and then they'll work their way back to replacement cost. And I think in a lot of asset types, not all of them, and this is the other challenging part, a lot of asset types, values and what things are trading at is certainly below, and in some cases way below replacement cost. And even then, some of those assets are not moving, uh, which indicates to me that people are just pricing in a lot of risk to those assets and uncertainty, because even at those significantly reduced values and pricing that you can buy things at, it's just difficult to pencil out what the future is, and build those pro formas and make assumptions. And so I think there's still a lot of uncertainty in the market, and that is definitely clear on some asset types and not as much on others. I think we could get into the differences and what we're seeing across the assets, but that's kind of what I think is interesting to me, is that there's a lot of deals that I see that when you just look at the dollar amount you can buy it for, the square footage, the quality of the asset, the location of the asset, just based on that, it may make sense. But to my point, there's a lot of other risk factors that are difficult to really understand right now. So
yeah, I would say that, and we'll segue here in a little bit to kind of what all that means in terms of if you're, someone on this call and you're running a fund or you got an asset strategy and you're trying to raise money for family offices, what is the impact on you as the manager? That's really, I think, where we really like to try to focus, right, with a lot of our clients and a lot of these webinars. But before we go there, I mean, in my mind, man, I would say the level of uncertainty is the most I've ever seen in how long I've been doing it, which is 35 years now. I mean, and there's been certainly times throughout that period where it was harder than others, but it always seemed to at least make some semblance of sense. Now I
Sure.
don't really even know how to make sense of some of this stuff because there's between secular changes and completely upending entire industries with artificial intelligence, with what's going on politically in the world, and it's just everything seems to be contributing to the uncertainty, which makes making any decision harder, which just means that people just don't make any decisions and they kind of just don't do anything, and then that just locks up the market even more, depresses activity more and prices even more, and it's just like that's what it seems like I'm seeing across the board with a lot of our admin and advisory clients in the real estate
Mm-hmm.
space. It's just really hard. Are you seeing? I mean, I know you guys have a pretty sizable real estate portfolio, and you're got it's like anybody, right? Some are doing fine, some are struggling badly, some are in between, some are unknown. Like, how are you
Mm-hmm.
seeing it in terms of the decisions you guys are making?
Yeah, I think that for us, we're really, when making new acquisitions, we're very focused on things that are cash flowing right now and can cash flow even at the higher interest rates when you put debt on it. And we're not over leveraging things, but or even aggressively in some cases. So cash flow is what we've reverted to and are focused on. When you start thinking about, I guess, the spectrum of investments, taking asset types outside away from it, you've got land and development deals all the way to call it retail type deals that have credit tenants or something along those lines. And even then, when you look at credit tenants and these single tenant triple net leases, like Walgreens was
Um,
um, considered to be like a treasury bill at one point, and now it,
go out of business.
everyone knows that story. And so who would have thought that 10 or 15 years ago? But that's how much that world has changed, and the demand for pharmacies and Walgreens and certain other asset types. So I guess when I'm looking at it right now, when you start looking at development deals, it's very expensive to develop anything, and there's a lot more variables that have to work in your favor: time, budgets, leasing, and then eventual exit, the debt markets. So I'm I'm really focused on um, what I've been saying to sponsors and deal guys is I don't want a lot of execution risk at this moment. I would kind of rather bank on tenants that have a strong business that are going to continue to have a need for the space that they're leasing, and take my chances that they're going to stay in that lease. And if they cannot, then I want to make sure that real estate's going to be desirable for a similar type of use from another business or whatever it may be. So that's kind of what we're looking at. And then, when you say all that, then multifamily has for a long time kind of been the darling of commercial real estate and considered to be lower risk. And even then, it's really difficult. I haven't really seen multifamily deals that are the numbers make a ton of sense um, anytime in recent memory. So it's hard for those things to pencil. I mean, the returns are just not there for the risk, at least what I'm seeing. I know there's exceptions here and there, so I'm sure there's people listening that are thinking of deals that they believe to be good, but that's really what we're focused on is just trying to deploy capital into things that are producing real-time cash flow
Yeah.
immediately without a lot of need to execute, without value add, without development, without that sort of thing.
Yeah. Yeah, and I know for a long time, the value add and the development stuff, and the development, of course, goes in cycles, right? I mean, it's sort of a boom or bust type business, just generally. But there's a lot of timing involved in that. That's just, I mean, your lead time on that is so long that by the
Yeah.
time you know, yeah, I mean, you're completely all in to the point where you just hope that it's not terrible timing for you. And that's, of
Yeah.
course, what happened in 21 and 2020, early 22, right? Is like if you were at the tail and buying stuff then, and we've experienced that firsthand. It's been a struggle. It seems like at some point, to your point about replacement costs, if there's a lack, I mean, all of this means there's less stuff coming out of the ground, less development going on, which means there's supply constraints down the road, which means eventually, things come back. And at some point, it seems like,
Yeah.
Politically, you're going to eventually you get interest rates going to come down sooner or later. And all of a sudden you're going on an uphill swing, and then you go on a run for 3 or 4 or 5 or 7 years. I
Yeah.
mean, it's just like, but you don't know when that's going to start exactly.
Well, and that's exactly right. And that really plays into what I'm saying is that, and you and I have both watched this enough, that these cycles they're each of them is different for different reasons and the risks are different. But generally speaking, what I have seen is that there are these time periods, usually several years, where you can find pretty strong cash flowing assets. And that's where the capital is generally going. And then to your point, a lot of that starts to get taken off the mark out of the market, and those opportunities become less and less. And then people move more into, well, they need to create returns. The cash flow type properties aren't producing those returns, so people move into value add and new development stuff. And then that tends to then be where the money goes. And then some event or situation or time period happens where, in this case, like interest rates shoot up or inflation runs, and then it becomes harder to do those development and value add deals, and capital freezes and dries up and the market stalls out. And then eventually capital that needs to get deployed is looking for return. And because the market is inefficient at that point, the pricing becomes better for cash flow deals again, and it kind of starts all over. So I think we're at that point in the cycle where there are cash flow type deals in certain asset types. And,
Office.
uh, well, office is one that, I mean, there are in place rents in certain office deals and retail that you can get at really really good cap rates and get positive leverage even at the higher rates. So that combined with maybe betting that rates will eventually come down and cap rates will eventually come down, maybe you then get the pop on the value, and maybe you don't and you hold on to it and just let it cash flow.
Yeah.
But what I'm seeing as far as construction and development, the cost to build things right now is really high. And I just don't know when or how or if that's going to go down, but people are going to continue to build. And that also, I think, lifts the existing properties, because in order to justify the risk of building, those developers are banking that they're going to be able to get certain rents to create those
Yep.
returns. And then a lot of times even if it takes a long time, they'll get those rents. And that kind of brings the rest of the market up. Even if you have an older vintage property, you don't necessarily get to the brand new rents, but it will rise all the rents. And so that's where I think we're at right now in the market. But all that said, to your comment about office is really challenging. I think there's a lot of offices that are doing quite well in certain markets and certain pockets of markets. And then there's others, like you look at some of the recent sales in downtown Portland, which we're not invested in, but it's kind of wild what some
No,
of those
dude, just
prices are going for.
Big Pink, the US Bank Tower just sold for $35 million. I mean,
And that's
35.
the largest or the tallest tower, at least in Portland, and it's an iconic building. And
Yeah.
it's to think about what it would cost to build that right now
Oh my
at
God. I mean, if you'd have
six,
told
seven
me
hundred, $800 a foot.
if you'd have told me, 5 years ago, 10 years ago, 15 years ago, 20 years ago that Big Pink could sell for 35 million bucks, I'd be like, there's no way. There's
Yeah.
just no way. And well, here we are, right? I mean, it's a crazy environment.
And that's a good example. When I look at that pricing, I go, well, the person that bought that, they used all cash. They're going to renovate it and put millions of dollars into it. That might work out to be a home run of a deal, but there's still, even at that price, that is a
Yeah.
lot of risk to
Yeah.
getting that thing to perform.
Yeah.
So
Exactly.
that's what's weird right now is the risk and reward is they're both potentially high.
Yeah.
And so it feels much more like Big Pink feels like quite a gamble, and it might really pay off big time. And to think that it would go for less than 35 in the future is hard to imagine too,
Yeah.
but given where it's come from, it's possible.
Yeah. So let's segue a little bit now to, as you sit in that chair and you have now, I mean, you used to be calling on yourself or somebody like yourself
Yeah.
to raise money and talk to them and develop relationships and so forth to raise money over time for either syndications or funds or both, right? And now you get approached by those people, managers. Like, what are you seeing there? I mean, let's maybe talk about what you like, what you don't like, suggestions you might have for people on how they can approach family offices in a way that's gives them the best chance of ultimately being able to raise capital.
The theme that I just see over and over again is people trying to shortcut a capital raise process and just skip right over developing any type of relationship and go straight for asking for an investment. And
Yeah.
that is what I see happen daily. I mean, an extreme example happened yesterday where my office phone rang, and hardly anyone ever calls me on my office phone, but picked it up, and I said, "Hey, this is Darris," and the guy's like, "Oh, what's your name? What's Derek? Darren?" And you've watched that happen with my weird name before, but after 30 seconds of him even trying to figure out my name, he just says, "I have a property and want to know if you want to invest in it." Right? And I'm
Yeah.
just
No.
no, thank you. Click. Right. But that's an extreme example. And then there's a lot of examples that are not that bad, but not much better, where it's just going straight into a pitch. And rather than even attempting to develop the relationship, where it may be like, hey, if that same phone call, and cold calling is generally, and I've tried and done everything, but cold calling is a tough one. So you don't want a cold call to pitch someone. You want a cold call to try to begin a relationship, and then maybe in 3 months or a year, then you'll have the relationship at a level that making a pitch or sharing what you're doing may then make some sense to see if there might be interest. And that process, what I find it takes a long time. And so you have to put a lot of lines in the water, and you have to be tending to those and building the relationship, not pitching. And I know the fire drill of capital raising is what creates a lot of pressure and desperation, which comes across when people are just going straight into a pitch. Once you have that relationship, then it is easier to call that person and just say, hey, we're working on a new deal. Are you interested to get together and, chat about it or something along those lines? But, I was doing this the other day, I was looking through all my LinkedIn messages, and same thing. A lot of the messages just start right off like, hey, I'm a affordable housing person, and I've got a deal, and I want to put some time on your calendar to tell you all about it. But if you're not currently investing, then never mind, or something along those lines. So it's like, that's just a bad way to go about it.
Yeah, I mean, your point is that it's a long game. Instant gratification is very difficult yet in today's world, and it's just human nature, right? Instant gratification is what people want. So, and part of the hard part for sponsors and managers is that it's a long game, and the business model of generating revenue relative to overhead is a difficult business model. I mean, it's super capital intensive, right? You have to raise both equity and debt at the property level. You need to generate fees to be able to survive. And ultimately, ideally, you want it to be such that, it's a win-win if you do well on the asset, but it can take 2, 3, 5, 10 years to get that. So it's a super difficult model for people. And I'd say this is why people also chase going out and hiring a third party to try to raise capital for them. Right. And that's what there's this, fantasy that there's some panacea to having someone else go raise the money for you. But I would say, it's just statistically, it's pretty rare. I mean, if you're going to go in the broker dealer world, there are some people that are successful there, but it's well down the road and it takes a long time. So what guidance do you have for people on how to be patient and how to, do what you're describing, where they can take the time to even develop the relationship when they've got to survive in the meantime?
That, I think you just hit it on the head. That's the hard part in balancing those two considerations and recognizing where some relationships are at relative to others. So when it comes to the need to close on a deal in a few months, you should be focused on the relationships that you already have to fill that capital. When it comes to the deals you're going to have in 2 years, you need to start building those relationships now and being extremely patient, because once you blow the relationship or don't actually put the time into it, like, that's not to say you have one shot at it, but it's kind of that way. And so you don't want to get the pressure that you're feeling as a sponsor, or the need for immediate capital, to ruin your chances for what it can be in a few years. So I think that's what I would almost suggest. You have like 2 types of investor lists. You have existing investors, or those that maybe aren't current investors, but you've developed a relationship. They'll talk to you, they'll take your calls, you'll meet with them, dinners, whatever it is. And then you have this other list of prospective investors that you haven't established that with, that you're maybe in between raises, you're constantly touching them. And I think also, in those cases, demonstrating to them that others are investing with them. So rather than saying, do you want to invest in this deal right now? It's after you get that deal raised, share with them the deal that you just raised for and what they didn't participate in. And that may create, if you do it correctly, a sense of some social proof that other people are investing, but also, fear of missing out sort of thing if you show them a deal after you've already raised for it and it's now going, because that may trigger them to say, show me the next deal when you have it. And so I think that's the other thing that people find to be very odd when I say this, but I genuinely, and I probably did do this, but I'll say it um, more for purpose. I don't ever recall asking someone to invest. And like I said, I probably did at some points, but it was more sharing deals, sharing knowledge, sharing what's happening, and letting investors reach their own conclusion that they do want to invest or they do want to explore it, or this does make sense for my portfolio, or this does meet my objectives. Because that's the other thing. It takes time for capital raisers, and they should do this, and most of them don't, to understand what the investors' objectives are and what they're looking for in their portfolio. Some people only want debt. Some people only want multifamily. Some people only want the Southeast United States, so whatever that is, it's a waste of um, it's a waste of the relationship and to be pitching them things that are outside of what they're looking for. And that doesn't mean you don't share with them and say, I know this doesn't make sense for you, but here's what I'm working on, because maybe that leads to that helps establish their ability to say no. And you want them to feel comfortable saying no. That's, to segue to that, that's the other thing that I see a lot of is sponsors or capital raisers making it uncomfortable for investors to say no, and that's just gonna get you hung up on or not get the next meeting.
Yeah, I think a lot of what you're talking about is true in sales just generally, right? It's like, you need to give permission to people up front to say no, that no's an okay answer because it lowers the resistance and the barrier to an open conversation. And if you can't have an open
Mm-hmm.
conversation, the chances of getting a yes are very low. So you need to be good at removing that barrier up front to begin with, right? Then you need to also be committed to helping them only find a solution that meets their needs and not trying to shove something down their throat. And this is, I'm talking about sales generally. I would say then when you're talking about raising capital and for a private fund as an issuer, of your own
Mm-hmm.
stuff, that's an even harder thing because of course it's people's money that you're trying to place and be a good steward of, which and doing it in an environment where you don't necessarily have control over all the factors that influence whether or not it's going to perform. I mean, you do the best you can. People have varying levels of capabilities and so forth. So all of that said, I mean, this is why I try to encourage people that if you can afford it, a lot of it is, okay, how do you set up your business in a way that allows you to keep your overhead as low as you can, but still have somebody who is there that's part of your organization whose entire or primary function anyway is focusing on developing, and I'm not even calling it raising capital, it's focusing on developing your capacity to raise capital, right? Because that's what
Exactly.
you're really talking about is, you need to build the muscle over time to be able to raise capital for your organization for the deals you're doing, whether it's a fund or a syndication or both. And that's a hard thing for people to get their mind around because it's a long-term proposition that doesn't happen overnight.
That's all. I agree completely with all of that. I mean, I think that raising capital is not you have a deal and you need to raise $10 million in 2 months, so go get it. Raising capital should be happening all the time, whether or not you have an active deal or not. Because raising capital to me is not about pitching. It's not about decks. It's not about like, look at these numbers. That's not what it's about. It's about developing a network of relationships, and that takes time, and that doesn't happen in the midst of the pressure cooker when you have a deal that you have to close. You need to be in a position when you have a deal that then you can go to that network and then try to bring in the capital. But that's not the start stop, way in which people raise capital. Is just, that's really inefficient and not effective.
No, and you're also, and that's, you're talking about a syndication where, there it's, you've got, okay, I've got a deal, it's under contract, I've got hard earnest money, I've got a date certain, I got to close by, right? That's one way to
Yeah.
do it. I'd say more, our administration clients are typically funds. So these are
Yeah.
discretionary pooled investment funds that are buying it. So it's a different form of raising where you're basically always looking at now, and that might be different in an open-ended fund versus a closed-ended fund, right? Because in a closed-ended fund, you have a finite raise period, and you're taking commitments. You're not taking the money necessarily all at one time. In an
Right.
open-ended fund, you're basically always taking the money in, especially if these are mortgage pools. So that all varies as well in terms of
Yeah.
how you have to raise capital for those vehicles, depending on what the structure is and so forth. But it doesn't, to me, it doesn't really change the underlying point, which is that you need to constantly be working on your network and your capacity to raise capital. So there, I'd say I've seen people spend crazy. I mean, look, we've done it over the years, right? It's tried a lot of stuff, spent money on
Hmm.
it, and it produced nothing, right? And it's a lot of that's
Yep.
how you learn, right? But it's like being able to. So, what do you see in your mind as being some of the most effective ways to? Because people need to be as cost effective as they can, right? Let's face it. There's lots of people out there that will happily take your money for quote unquote
Yep.
raising capital, right?
Sure.
That it just ends up not working. Any suggestions for people there, especially as it pertains to the family office world? I mean, you and I have been to conferences where we were supposedly going to meet family offices, or even guys like you and your counterpart that aren't part of the family, but you're working for the family, and then you're there as a representative of the family, right?
Right.
Any suggestions there that people can take away from this in terms of how to get into the family office world?
Um,
No
no,
magic
I
bullet. No.
they're just, it's not easy. And that's partly why I said earlier, like when you, it's hard to even identify the families. And then it's hard to find the families that may be interested in real estate. And then it's hard to find the ones that are interested in real estate that are interested in your real estate and your strategy and your structure. So that's why I think just developing a method to even identify them in the first place, and then systematically figure out how to meet with those people, and not meet with them to pitch them like I've been saying. It's more, you know if you learn that a family that's on your prospect list is going to be at a conference, then go to the conference and make the effort to at least introduce yourself to that person, and take, it's almost like you need to take small wins, like maybe you go to a conference and you have a list of a few people that are going to be at a 500-person conference, and if you can meet those few people, take that as a small win, and then get another small win, like fly out to go and visit them at their office. Don't make them work for it. You don't want them to, and even saying that, like whining and dining people, and that to some people, they don't want to go spend the evening and hours with capital raisers, and some people do. And so it's not necessarily um, just going in for the kill. I think just be happy with small wins and progress that along until the point that you have a real relationship with those families. I think for me, historically, identifying those groups was usually the hardest. And then trying to figure out how you get an audience with them is second. And that is challenging because each one of them is different as to how you're going to do that. Whether you have a mutual connection you can get an introduction from, or you run into them at charity events that you both are part of, or whatever it is. I think get those wins, and then eventually it will become a business discussion at some point, but you shouldn't start off with that.
Yeah, and so to that point, we have a question, Darris. It's says if I was fortunate enough to earn an introductory relationship development type lunch meeting with you or some other family office executive similar to you, and I wanted to give you something, without asking for anything, what would you appreciate getting? Not swag or picking up the lunch or anything material, but like knowledge, information, like what would be engaging to you?
For me, I really like the information. I don't necessarily like, hey, we wrote this report, even though I will read those occasionally. It's more that I like to know what's happening in different markets and different segments and what people are seeing, and real talk, like we started this conversation off. I mean, things are hard, things are challenging. There's risk here, there's risk there. Rather than sugarcoating everything, I like to know really what's going on with things, because that helps me whether I invest with that person or someone else in that space. That helps me um, in what I'm doing, but that also is what begins to establish trust amongst that relationship, and the interest to talk to that person. If I find them to be knowledgeable and a straight shooter and not sugarcoating things, that is what's helpful. Because the other thing about this is, when you do make an investment with someone, you're married to them, or however you want to phrase it, through the life of that investment. And not every investment goes exactly, most investments don't go how it's put on paper and the pro formas and everything else. And so there's going to need to be discussions, sometimes hard ones, to be had over time. And I want to know the counterparty on the other side of that investment, the sponsor, is going to be there and have that discussion and not bullshit me of what's really happening. So that's the type of value I think people can give. And that all said, that works for me. But when it comes to, in my case, and this is what I've witnessed as a capital raiser, when it comes to the actual family members, they don't necessarily want that. They're not interested in that. And that's of course different. There are certain family offices where the family members are heavily involved in what's happening in the market and everything else.
That's one thing I've felt like over the years, and we've talked about this with families that are the family offices, that it's tough, is just every one of them is different. Their structure is different, their level of interest is different, whether it's the person that originally made the money or it's the next generation of people. Like, their level of engagement and interest is different. They have other issues they're dealing with constantly, of managing their wealth or philanthropy or personal family issues or matters, or there's just
Mm-hmm.
it's a very difficult segment to me to have to find any predictability from one to the other. Like, like in the RAA world, for example, at least, I mean, those people are professional money managers and they have a job to do, right? And from one to the other, yes, they're still different, but at least there's some continuity from one to the other in terms of what you can expect, because they're all kind of dealing with the same thing. The families are not that way, in my experience. Would you agree with
I
that?
agree. Yeah, it's all over the map. They've got their job, the family members, the people that made the wealth, have the wealth. Their jobs are not to necessarily maintain and grow the wealth. They're just living their lives. And that's why certain families, like the one I work for, they have a staff where it is my job, but it's also my job to balance between what they are dealing with that you just mentioned, whether philanthropic things or timing of cash flows or family matters, and running the business. And
Yeah.
so that's why I said earlier, like, you need to allow people to say no, and you don't necessarily need to know the reason for that. And someone like myself, I'll usually say it. Most of the families I dealt with when I was capital raising, they wouldn't tell me the reason. that's perfectly fine. But you need to make it comfortable for them to say no, so that they know if you call again and they say no, then that's okay. But if you start guilting people and pressuring them, and like, then it's done. You'll never get back in to have that discussion.
Yeah, I mean, I think the takeaway in my mind for this discussion, and if anybody has any other questions, feel free to type them in. To me, it's capital raising is a long game. That's just the bottom line. And the people that try to short circuit it, or expect that there's some magic solution, there just isn't. I mean, and so the challenge becomes, how do you set up your business in a way where you can afford to systematically develop your capacity to raise capital without wasting a bunch of money going down dead ends that just aren't going to produce anything. And that is not an easy thing, to do. So,
No.
especially, and it's very true in the family office world, and I think there's lots of different, I mean, how many different family office groups or conferences did we, go to over the years? And like, how many of those bore any fruit?
Very few, if any. I mean,
not very many. Not very many.
no, the ROI on doing that was very low. And, and I see why. I've gone to family office conferences now as a true family office. And it's a lot of what I'm speaking about. Some people did a good job of meeting at those conferences and then doing appropriate follow-ups, and at some point that might bear fruit for them, but most of them didn't. And a lot of the families at those conferences, well, families were actually just real estate people that are hanging themselves out as family offices, maybe because they have the wealth, presumably, but they're actually there to raise money and not invest money. So that creates the challenge at those sort of things as well.
Yeah, I
And
mean, I feel
that
like
goes to my point of the prospect list, right? Like, if you were going to build a list of people that you don't even necessarily know right now that you might want to know, I think that's one thing to differentiate, is which of these family offices are investing with other sponsors and which of them are raising capital.
Yeah, I feel like it's much more of a sniper approach than a shotgun, right? Is like, okay, who are the families that make sense for me based on where I'm located, the type of assets that I do, or that might make sense, and then deliberately cultivate, a list, and then do homework on that list and figure out
Yep.
what's what, right, as best you possibly can, and then take a long-term approach to developing a relationship. And that might be different from one to the other, but that requires time and effort, not necessarily tons of money. And I think
No.
you're going to get a better result from that than you are from just flying around, going to different conferences and hoping to run into somebody, that
Yeah,
turns into a halfway decent
exactly.
investor.
Hope is just not the strategy. And that's why I'm like, so as an example, I think if I, you know, like, I'm in the Northwest. So um, it's easy enough to say, well, Bill Gates is a family office, or, Paul Allen's foundation, so I'll go try and raise from them. That's not what you want to do. But here in the Northwest, there's been a lot of wealth made from timber, generational wealth. So it's like, okay, who are those timber families? And then if you get cozy with one, then they probably know others. And you don't, and just by hanging around them, you'll figure out the others, and that sort of thing. Or if you're in the Bay Area, maybe it's tech people or whatever it is. I think just looking for those groupings of certain wealthy type individuals makes some sense, and then figure out what your ability, and be real with yourself to get into that. Like, obviously professional athletes have a lot of money. Well, can you crack that code and get in with professional athletes, and be honest with yourself if that's actually a good effort or not? So,
Yeah,
you know,
and
some
usually,
people, as we've seen, dentists, doctors, it doesn't necessarily need to be family offices, but finding these certain segments where wealth is, I think can help people focus on where to spend some effort.
yeah, I think being very deliberate and thoughtful about it is probably the main message. And then having it's either the principal or somebody that is working closely with the principal that does that most of the time, right? Because if you're not
Yeah,
doing it most of the time and it's an afterthought, then it's just never going to get the workouts that it deserves to build the muscle necessary to ultimately be successful doing it. It's just going to always be,
that's
half
right.
baked. And then that's when people say, well, I just want to find somebody to do it for me, right? Can I just go out, right? And then they start doing things that end up becoming very expensive with very low return on investment.
That's right. Yep.
So, all right, well, we're running out of time. So, Darris, I appreciate you joining us again. We'll have you back, I'm sure, at some point down the road. And I thank you, everybody else, for participating. I know we have another one scheduled for, I think we got them August, September, October. I think they're all scheduled. I don't remember exactly what they are, but I'm sure they're fascinating, just like this one. So please come back next time. Thank you for joining us. Have a great day. See you, Darris.
Thank you.